Welcome, everyone. Thank you for joining us for our first charity webinar. I'm Jill Halford. I know a number of you already, but I head up the charities team here at BDO. I hope you're all keeping well in these really challenging times that we find ourselves in. Thanks for joining us. And as most of you know, we usually do our charity training sessions face-to-face. Obviously, that's not possible at the moment, so we thought we would do a series of webinars. We hope this is the first of many. We're trying to keep them short and sweet, but we do have a lot to cover. So over the coming weeks, we will issue some additional topics that we would like to cover over the coming weeks in the subsequent webinars, but we also really welcome your thoughts on what those are. So if you do have any thoughts, do contact us. We're really open to ideas as well. We've been getting lots of queries and questions, specifically, obviously, to do with COVID-19, the ramifications on financial reporting, and also going concern. So while we've been going through our December year-end audits and also into our March year-ends, as we're midway through at the moment, we just thought it would be really helpful to start a series of webinars on COVID-19 and those implications, trying to answer a number of those questions that I know a number of you have. So who am I joined by today? Well, you've already heard from Rob. Rob's our technical director, and he's going to talk us through going concern and some of the financial reporting implications. I know a lot of you will be familiar with Fiona, my fellow Charities audit partner, and she's going to talk us through some key questions that trustees and readers of the accounts should be asking. And my fellow partner, Mark Sykes, is going to talk us through a great forecasting tool that he has, which hopefully will help answer a lot of your questions on that. So what have we got to cover for you today? So I'm just going to kick off with a little recap on where we are and what I hope will be a helpful rethink strategy launch, which I will explain a little bit more about before, but that's all about how do we come out of the crisis and how do we build a better business model going forward. As I mentioned, Rob will cover the next three items: our approach to going concern and auditing that, any potential ramifications on audit opinions, and financial reporting implications for your accounts. Mark's picking up the forecasting tool, and Fiona will be doing some key questions. Hopefully we'll have about 15 to 20 minutes for questions towards the end. Okay, so let me kick off. So obviously in January 2020, the World Health Organization declared COVID as a global pandemic. And that had ramifications across both macro and micro economic levels. And obviously, it's interrupted movement of people, goods, and many levels of government have imposed restrictions around individuals, on businesses, and as well on our operations as charities. So we're definitely feeling the impact. I think across our charity base, charities have experienced that impact to different degrees. And I think what we will see is that will continue to change and evolve over the coming months. I think the issue is common to all. So early in the lockdown period, NCBO did a lot of research to assess the likely loss of income to the sector. And they were estimating £4 billion over the 12-week lockdown period. Now, coupled with the increased demand on services as well as that loss of income, obviously a lot of certainty for our charities. We've had a number of cancellation of fundraising events. We've had closure of over 9,000 charity shops across the UK, although I was pleased to see that some are coming out of that lockdown. And if anyone does have a really helpful Charity Retail Association guide on how to open your charity shops, we saw a big fall in investment portfolios that charities are holding just as lockdown started, and we've seen a slight recovery. But again, the uncertainty of that continues. And I've been having lots of conversations with clients around the claims legacies and also when that comes through, as well as the actual value of the estates when they do come through. So I think a lot of the uncertainty around cash flows and around reserves. What has been interesting is that we've been seeing a lot of charities where they do hold investment portfolios obviously not wanting to crystallise the losses that they've been seeing in recent months. And therefore, they're exploring different options for cash flow rather than crystallising those and taking cash out of the investments. And I'll come on to a few of those in a moment. I've seen a number of charities launch emergency funds, which have been doing very well to help ease that gap. And we've seen various initiatives as well, such as the 2.6 Challenge, which we at BDO embraced as well. So Fiona and myself spent time on a treadmill and a paddleboard to try and raise funds for our charities as well. So I think we'll continue to see that those pressures on liquidity, but the government have announced a number of support mechanisms. And some of you will know that one of my roles outside of BDO is I'm the treasurer at AKIVO, which is the Association for Chief Execs of Voluntary Organisations. And AKIVO, as well as a number of the other umbrella bodies, have lobbied extensively for funding for the sector. So in early April, the Chancellor announced the 750 fund. I think that is a frontline focus for people that are directly working with people affected by COVID, and also for community foundations, so the smaller end of the sector. But I was really pleased to see that the CBILS business interruption has recently been opened as well. So there was a restriction on that, in that you had to prove that you had over 50% of your income was trading income, which actually precluded a lot of our charities. So I'm really pleased that that's been lifted, and I've actually seen a number of my clients apply for that scheme and been successful, which has really eased a lot of cash flow pressures. The other thing to note, I think, is just the quantum of furloughing across the sector. The last report that I saw was over 20,000 charity employees on furlough from just the top 20 charities in the UK. So you can see there's a huge number. And we've been supporting our clients through submitting those. It can be quite difficult to process, especially where you have a vast number of employees on the furloughing scheme. There's a lot of grant funding out there as well. So, for example, Barclays have come out with a £100 million scheme which you can apply for. And also the government have launched a support finder tool, which I hear is very helpful. It's quite quick. It's an online questionnaire which takes a couple of minutes to fill in, and it can determine what type of financial support is available to you as an organisation. Now, that doesn't include a lot of the Barclays fund that I mentioned earlier, and a number of the other ones as well. So I would encourage people, if you haven't been onto the Institute of Fundraising website, they have a very helpful list of other grant pots as well, and that's kept up to date on a very regular basis. So I would encourage you to go on to that if you are looking for different sources of funding, making sure that you're maximising all of that's available to you. So at BDO, we've been trying to support as much as we can throughout this difficult period. And one of the things that we've been looking at is our rethink model, which I've tried to summarise very briefly here, but it comes with a lot of information in the guide, which we will circulate afterwards with the slides as well, because I think that's quite helpful. And I think events are moving very fast. Every time we issue a bit of guidance to the sector, you may have seen a couple of our booklets that we've issued. It is out of date before we even kind of go to print and send it to you. So we're trying to update these things very quickly, but events are fast moving for you, and it's very difficult to horizon scan as well. So what we've been looking at is really, what stage of the business life cycle are you in at the moment? Moving out of the first phase around safeguarding your business, which is, I think, what a lot of organisations experienced in the first 2 months. How do we recover from the crisis, and what does the next phase look like? So I've got a number of boards, a number of conversations happening to really assess where they are at the moment, where they would like to be in the short term, and then realistically what it's going to look like in the mid to longer term. And that can mean some really difficult decisions. around right-sizing the business for the estimated income that is coming in. So what I'd like to do is just share this guide with you. I hope it would be helpful. It's really focusing on building resilience. How do you recover from the crisis? Offering some general guidance and putting a bit of a structure around some of those conversations that you're having at board level. We recognise that every situation is different, but we hope that this methodology that we've pulled together will help decisions around the next phase of where what you're approaching, help manage those priorities, and leverage and structure around thinking. I think it's fair to say it's been a very difficult period over the last couple of months, and I'm sure you've all experienced that. But there are some benefits. I think there's a number of things that we've been meaning to do for a long time. I think the situation's helped us reassess things like our property strategy, and do we need the large headquarters in central London, for example? And also it's really expedited, I think, our digital transformation. This following slide is an extract of a tweet, which was actually from my chair at Akivo, and I thought really resonated with me, because I think we've been trying to push forward digital transformation for many years. And actually, I think COVID-19, while it's been very difficult to manage through, I think it's had some benefits in that it's forced us on that digital transformation journey. So hopefully that's helped set the scene. I am now going to hand over to Rob, and he will take us through the next stage.
Thank you very much. So I am going to just pick up on the accounting, auditing, going concern related point. So I will start with a little bit of a discussion about going concern, because to be honest, over the course of the last couple of months, this is the area in which a number of our clients, when we are going through the audit process, express quite a few concerns about the kind of the level of detail that auditors will go into, particularly where you as management or financial controllers, finance directors of a charity strongly believe actually this coronavirus and COVID-19 situation really doesn't impact too much on your ability to continue. Usually we're seeing clients feel that they can quite easily scale back their operations so that they can just continue to weather the storm as it progresses, and therefore feel that auditors are being quite almost aggressive in their consideration of the going concern status of the entity. So I just wanted to clarify a few points on that about what's kind of going on in the background in terms of audit or going concern. The first thing I will say, and I will bring in a bit more detail of this in a second, is that we were already pre-COVID-19 under a lot of pressure as auditors to really kind of enhance the work we were doing around going concern. That's not to say we were being expected to presume entities were not going concern, but we were being, as auditors, being used as a tool almost to drive our clients to be much more on top of their going concern assessments. So that effectively, if at any point during a business's life cycle or cycle of a financial year, the trustees or the finance directors were challenged, why are you comfortable you're a going concern? What issues do you see on the horizon that might give you a problem, and what are you doing about it? Clients could answer that almost with the click of their fingers, because they were kind of all over that going concern assessment. Really, again, trying to move away from the idea that this is a audit issue only, and that this is actually something for good governance, really, that trustees and management should be on top of. So, as I say, auditors are being used as a little bit of a tool for beefing up this area in any case. And really, the COVID-19 situation has really only exacerbated expectations on auditors and what we are supposed to do when we're carrying out our audit work. Now, I think it is very clear to everybody, and I don't think anyone would be very surprised to hear that the auditors, not just BDO, but the profession, is approaching audit of going concern at the moment with a bit of a presumption that there is an issue. And then that puts the ball in the court of the trustees and management to come up with, well, why is that not the case? So presume it's a problem, and let's hear the arguments as to why it's not, just so that there is that very clear challenge, thinking it through and making sure that if we're comfortable there isn't an issue with going concern, that is well explained and very transparent in the financial statements. We've had a number of, not just clients, but a number of operators in the sector basically saying, this is an issue that affects everybody. Why can we not do more just to take this issue away so that we don't have to keep answering the same question? And I think it's interesting and not a bad kind of starting point. I think what our regulators in the audit world, and I know the Charity Commission are equally as interested in this too, what our regulators are more likely to be interested in is the education piece. So not trying to take away the going concern questions, not trying to pretend they're not there, not trying to think about how each charity is responding to those going concern questions, but really then educating interested parties and saying, you are likely to see a lot more charities with some going concern question marks. That's not to say not going concerns, but going concern question marks. What does that mean then? And what impact should that have on any economic decisions that you take? Regulators have been much more interested in that education of users rather than trying to argue this point away at all. In terms of our audit approach to going concern, BDO continue to sign audit reports. We haven't stopped doing that. We are not one of the firms, and some audit firms have understandably, in a lot of cases, said, whilst there's so much uncertainty about final position, we're just not going to sign off on any audit reports because there's so much uncertainty, we potentially could be in limitation of scope territory. That's not really where BDO is as a firm, and that's just our decision taken, but more that we continue to sign audit reports and we continue to agree sign off on each client's own merits. Where there is significant uncertainty such that it would impact the opinion, we have a robust discussion with the client about what the effect on the opinion would be, and we really put the ball in the court of clients to decide how they wish to proceed with that. But there is a continuation of signing of audit reports, although for some public interest listed bodies there was a bit of a moratorium on signing, and that's not really translated down to some of the charity and other not-for-profit sectors. Other point on our audit approach to going concern, I've kind of alluded to it already, but you can expect as finance directors and trustees, you can expect your auditor to ask you some quite hard questions about going concern. That's not, please, as you go through that process, don't take that as a personal attack on your charities. We have had some clients sort of saying, almost, I can't believe you're asking me that question. Of course we're a going concern. We are more than happy to conclude that's the case, providing the evidence is there to support that. And where you might get challenges, etc., from your auditor is, I completely agree with what you're saying, but let's think about how we demonstrate that and how we make that clear to users the position that you're in. So as they don't take that personally as you go through an audit process. If you get some hard questions being asked about going concern or get asked for your view on what the worst case scenario might be for your organisation, it's something that auditors as a profession we're being encouraged to do across the board. Just be more robust in the challenge that we put to that going concern conclusion. The one thing that as part of our audit approach we will be quite hard on and arguably quite pushy in some cases is the disclosure in the financial statements. We've seen a number of clients saying, and with our agreement as auditor as well, we are very clearly a going concern. So there's not an awful lot of question mark about whether we are still going to be here in the next in 12 months' time. And as auditors, we've challenged management on that point, and we've agreed that that sounds very sensible. We can see the case behind it. What we do want then is for you as the preparers of financial statements to be very clear in your accounts why you've reached the conclusion that you have done. That is slightly, in some respects, gold plating the accounting requirements, because the accounting requirements in the SORP talk mainly about if there's a material uncertainty, please disclose it. If you conclude there isn't a material uncertainty, you arguably could get to a position where you don't need to say anything at all. I think unfortunately though, in the current environment, we have, as have our regulators, both charity and accounting regulators, really geared up users to expect a problem here and actually to have it explained to them very clearly why there is not a problem. So again, auditors will be quite pushy in terms of the principles of accounting, which say that your financial statements need to include information that is relevant, reliable, understandable, and allows users to compare your financial statements with those of your peers. So to be able to do that, we strongly believe, particularly at BDO, but again, I know others in the profession are of the same view, that really needs some good disclosure. So say, even if you think my charity is clearly a going concern, there are no issues as far as we're concerned. Coronavirus has not really impacted on what we're doing. We would still say you need to explain that then. You need to be very clear on why you've reached the conclusion that you have done. And there could be implications for audit opinions if you consider that's something you don't wish to do. So again, expect some robust discussion around all of that as you go through an audit process. Indeed, some of you may have recently gone through some robust discussions on it. Internally, and again, it's not necessarily for you guys to worry about, but internally, we have implemented a number of additional quality assurance procedures. So we have other partners involved, potentially technical standards reviewers involved in some of these going concern decisions, just to make sure that risk exposure, both for you and for us, is kept to a minimum. But you can be assured that we are looking at that quite carefully. I'm not going to go through all the details on this particular slide, but it's just to echo the point I made at the beginning. COVID-19 has brought this going concern question into stark focus, to be honest, but we were already under a lot of pressure from our regulator to give more attention to going concern. And to try and put some burden back on you as trustees and management of charities to be on top of this. So even when the COVID situation perhaps starts to peter out as we get into 2021, 2022, you can kind of expect these going concern challenges to continue to persist. Auditors will ask you, why are you confident? And expect almost for you to be able to answer that at any point in the year that we ask you the question, because it is so fundamental to your ability to continue. The kind of going concern impact in terms of audit implications and what we're expecting from you. A couple of other things to mention about audit reporting and what you might see coming out from your audit report on your financial statements. I mentioned that our regulators have been quite keen to gear users of financial statements up for what they might see. And what regulators have been trying to educate users on is, over the course of the next 12 months, you may well see more modifications in your audit report. You may pick up an audit report for a charity and you might see some additional narrative in there. That may be because auditors and charities have come to the conclusion that whilst it's appropriate to conclude the charity is a going concern, there is nevertheless real significant uncertainty, key judgment that has been taken in reaching that conclusion, and that judgment is very important for users to be aware of. That is something that does warrant reference in an audit report. So you may see, and the profession may see, more material uncertainties referenced in audit reports. I suppose it needs to be clear that we're saying that's not a qualification. We're not saying an entity is not a going concern. We're not saying we don't agree with the going concern conclusion. What a material uncertainty about going concern reference is really about is drawing users' attention to judgment, essentially. It's saying we agree with everything that's been said, but we think this part of the accounts, which tells you all about that judgment, is really important for users to read. And that's what material uncertainty, we might expect to see more of that in reports. We might expect to see more emphases of matter. We know, for instance, where you've got things held at a valuation and you engage an external party to provide insight into that valuation, we know a lot of those external third parties are introducing their own disclaimers and qualifications, almost saying, we've given you an answer to your fair value question. We've told you, for instance, what this property, what we think it was worth at the 31st of March, but you need to be aware that that was a point in time that was really uncertain in terms of assumptions. So the outcome might actually be very different. And again, whilst that doesn't result in a qualification in our audit report, that doesn't necessarily say we've got no evidence about the value of a property. What it does say is there was a lot of information provided about uncertainty in that valuation that it's important to draw users' attention to. So again, you might see, or the profession or users might start to see charities with more of these emphasis of matter style paragraphs included within audit reports. The final one on the list is a qualification and would be potentially quite serious in terms of its implications for users' interest, is where, as part of the work that we're doing as auditor, we find that our scope is limited. You'll be aware from your experience of audit before, I'm sure, that we are not really supposed to have our scope limited. If there's something we want access to as auditor, we are generally in law required to have that access and entitled to do so. But clearly the current environment we're operating is quite challenging. I mean, you can see all five of us are sitting behind desks in a spare room in our house. It's not that easy necessarily for us to get to you at clients, to be able to see the environment you're operating in, to see how you're operating on a day-to-day basis, and really just to get a feel for how things are working. And that does, in some cases, place limitations on the scope of our work, because a lot of the evidence that we gather as part of our audit work really does require almost seeing the whites of your eyes as we talk to you and getting insight into what you're talking about, and asking you to show us bits of paper sometimes, so you show us the evidence of that. Now, whilst modern technology facilitates being able to do that and for you to be able to provide information to us electronically, where we're talking about things like attendance of stock counts, where we would think, actually, I need to see the condition of that property, which the valuer is putting a little bit of a question mark over. Sometimes that does require physical attendance. Sometimes, for instance, operation of your control, we sometimes want to physically see it with our own eyes, and we're not able to technologically facilitate viewing that in any other way. That can unfortunately lead to a limitation in the scope of our work, a lack of audit evidence, which would result in a qualification. The profession, again, our regulator, particularly the FRC, has been trying to gear up users for that being a much more common occurrence, because it is unfortunate that in some cases there is just no alternative for us, where we couldn't attend a stock take at the 31st of March because government guidance suggested we were not allowed to. You probably were not even allowed to carry out a stock take at that date. So what do? There's not an awful lot of other alternative options. Technological solutions don't always provide the right answers. So again, we might see that much more commonly in practice. Honestly speaking, for charities, that's not expected to be as common, because it's unlikely you'll have material stock that needed counting at 31st of March, for instance. But to the extent that you do have those sorts of issues, your auditor will hopefully engage with you very early in that process and talk to you about the possible implications. But again, any questions on that, do stick them in the Q&A. I am going to just mention in terms of audit reports about how just the experience we're seeing. We get a lot of clients asking us, are we actually issuing reports with a lot more of these sorts of changes, these caveats, these emphases of matter, these material uncertainties, qualifications? And the honest answer is, at the moment, probably not. We're not seeing an awful lot go out the door with these sorts of changes. It's difficult to present examples and to say at the moment this is a really common occurrence. But I think that's because, and our experience is that's because the vast majority of our clients that might be much more in a material uncertainty territory, but might have significant questions about going concern, they are more inclined to wait before they issue their financial statements for as long as they can to see how much that uncertainty actually levels off. Those that we are tending to sign out at the moment are going out the door they are clear going concerns with really good disclosure about why that's the case. So we very quickly get ourselves comfortable that that's appropriate and that's what goes out. So disproportionately speaking, we're seeing a lot more normal, in inverted commas, audit reports, but that isn't expected to be the trend over time, over the course of the next few months. So we do still expect to see that, but perhaps there is a little bit of a lag in terms of we're likely to see that when we hit filing deadlines a lot more than we are in terms of those signing out at the moment. Okay, any questions on that, stick them in the Q&A. The financial reporting implications, you'll see a lot of information on slides, but to be honest, I really just want to hone in on just a couple of principles, really, which is for those with 31st of March year ends in particular, and I focus on 31st of March because I think December year ends are probably well underway, if not almost completed. For 31st of March year ends, Covid-19 is expected to be an adjusting balance sheet event. So we expect that it will have occurred pre-year end, not least because the pandemic was declared in January. So this is something that has been expected to have occurred in year. And that means it has an influence on particularly things that involve valuation at 31st of March. So things like legacies, valuing voluntary income, grant income, the extent to which you are able to value those, the extent to which you think those things are expected to be recovered should you call on them and that sort of thing. Those are things that all needed to be taken into account when auditing and preparing your financial statements. So you very much have to put yourself in the mind of, at the 31st of March, what did I think about, for instance, a donation from, let's say, one of the big travel companies, for instance. Whilst you had a pledge in from one of those companies, could you really expect it to be recovered as at the 31st of March? You might have felt that there was a bit of uncertainty in that. So there are question marks, therefore, about recoverability and value, for instance. So there's a lot of accounting implications that really just result from the uncertainty that you would see at the 31st of March. Things that would be much more certain at 31st of March are things like trading subsidiaries. So at 31st of March, you might have some small trading subsidiaries which are doing kind of largely incidental activities to the work that you're involved in. You might have some question marks about whether or not those sorts of subsidiaries might have material uncertainties themselves about going concern, because they might be the first area in which you cut costs, for instance. So there's a lot of considerations around group activity and what it looks like from the perspective of individual subsidiaries. And there is just generally, in terms of preparing financial statements, a lot more consideration, to say, about judgment taken. Your accounting policies, your judgments and estimates, you can expect there to be a need for a lot more disclosure this year in terms of why you've taken the decisions that you've taken about numbers, for instance, that you put in your accounts, and the level of kind of recoverability and entitlement judgments that you take. But again, specific questions on those, anything that you're particularly worried about or accounting issues that you'd like us to consider, stick them in the Q&A. And again, when we get to the Q&A bit, we'll see about whether or not that we can kind of provide some immediate advice on those. The one thing also just to mention is the narrative reporting bit. So the bit at the front of your accounts where you talk about your strategy, looking ahead, your recent performance and all of that sort of thing. Again, very much need to consider that as an adjusting event. So we would expect the COVID-19 situation to have quite a significant impact on what you're seeing around your kind of strategy, your planning, the impact of your recent performance and your and what you plan to do next. All of this stuff should impact that. So very much considering that COVID-19 is woven through your narrative reporting. We've seen a number of clients, particularly around the March-April time, almost presenting COVID-19 as an afterthought, saying, well, we've got this plan, coronavirus, yeah, it's going to have an impact, but we'll deal with that later. I think as we more and more move through this scenario, we can expect to see much more detailed plans that have this woven in. But I suppose what I'm saying here is, with that narrative reporting, think about the variety of impacts that could have, your reserves policies, your Section 172 statements if you have to produce them, your kind of audit reporting, as we've already mentioned, your policies, your judgments. There's a lot more words that need to go alongside this. And as it is on the slide there, also think about approval and filing requirements, charity commission guidance and that sort of thing that might come out at any point in time, because we are in such a fast-moving situation. The latest guidance now may not be the latest guidance when you come to sign off, so just make sure you are familiar. Just the last thing from me, I think, on in terms of reporting, there's a few things just there on the slide, I think, in terms of the sorts of things that you'd want to mention in your narrative. I think I've already mentioned really about keeping that as a very live exercise, making sure it's woven in. But I think, as you can see there on the slide, there are a number of areas of your narrative reports that you might expect this to have an impact. Your control measures, financial uncertainties, your financial statement, sustainability and going concern as mentioned, contribution of volunteers, how your outbreak has affected your ability to actually operate the way that you want to operate, impact on reserves policies, anything that has an impact on your future aims, and anything really importantly on wider network. Actually, just so any organisations that you work very closely with, perhaps overseas organisations, any businesses that you associate with, what might have been the impact on those partners almost, and therefore what that might do to your effectively supply chains, as it were, the organisations that you work very closely with. And as I say, think about that for a few moments as we move in through a couple of other topics, and anything specifically on the Q&A you want to ask, then please do so. I'm going to hand you over to Mark Sykes now, just to talk to a little bit about financial forecasting.
Yeah, thank you very much, Rob. And just to build really on what Rob was saying there, the reality of actually being able to some kind of forecast, it sounds very much like an accounting thing. What we wanted to do here was do something that really helps you as the decision makers within the organisation to think about what you need to do to protect the organisation. So this is, whilst it is a major audit concern, as Rob was referring to, it's actually more about good governance, ensuring that these charities can actually continue operating through what is probably one of the most horrific times that we know on record. And Jill painted that picture at the beginning of everything that was going on and the impact in terms of donations and events and activities. And yet it's still a time when the services of charitable organisations is only going to get more and more important. People very easily can see a strain point there between the balance of the demands for what charities do and the valuable part they play in society, combined with the challenges around fundraising. And even topics like being able to get a receivable loan, experience has been that, first of all, many lenders turn around and say, you've got plenty of cash in the bank, so do you need a receivable loan? And they have declined on the basis of that. And therefore, it's actually really important to be able to turn around and say, no, I've actually done my projections and forecasts, and I can see the impact it's going to have, and yes, I do need to borrow. But at the same time, it's also worrying that you are able to repay it. Because the last thing we'd want anyone to do is to borrow without being able to have confidence that they're going to be able to see their way through. The rethink model as well is also really powerful because it's getting people to rethink what is going on there. So, as well as the responsibilities of trustees, it's also about improving decision making because things are going to change, and the way we operate, social demographic factors are going to be different in this country on the back of this. And as those changes take place, even this morning I was hearing about the National Trust and having to book ahead. So rather than a spontaneous turn up and go and visit, you're going to book ahead. And we all know things like that will change demand and the way we engage and interact. So it's important that we think about those different scenarios, costs of implementing changes and the ability to through that. And then the other thing is many organisations fail because they just didn't see something coming. They forgot to build any form of resilience and think about those short-term pitfalls. As with charities, you've got to maintain that reserves policy. Many charities probably put a figure out of 6 months reserves or whatever. But actually, what's that based on? And COVID, once again, has made this front of mind. You need to ensure that you have a well-devised reserves policy. And if you are going below that threshold, effective plans for how you're going to remediate that position and come back. So, that's the forecast. Short-term, that's making sure that the cash coming in the next work to cover the costs that might be about to be incurred, but also then think about the longer-term budget and forecast. Can you afford to repay that loan? Should there be one, or any plans for restructuring and reorganisation? But also scenarios, and this is probably the bit where I get more excited. It's about saying the what if. So let's rethink how we're operating. Think about the different comeback scenarios you might have and which one represents the best and the most likely strategy for yourself. Now, that's all great. There's a lot of theory in there and importance around what's going on. And then when we think about the scenarios we need to consider, we have things like a second peak. And will there be one? Could there be one? How long could a recession coming on the back of this be? Is it going to be a short recession, but there's going to be a nice bounce back, or are we going to see it prolonged? Donations, events, when are events going to get back for people to be running London marathons and so forth? And furlough. How long does furlough continue for? We've seen extensions out there of that, but do you need to bring them back sooner because of the services you need to provide? There's a whole range of things, and then the last one there, the pestle facts of those political, economic, social, technological, legal, and environmental changes. The world will change on the back of this. We can't avoid that. So what we've done is we've basically worked with someone else to put together some technology to actually help you with this. It's cost effective, I will say that, and it's designed that we can help set you up, can help you build the forecasts, but we can also set it up so that you can then run the different scenarios and have a go yourself in terms of saying what the different outcomes might be. Now, I've not gone for the live demo here. I've got a crackly line going on, and I can see technology maybe failing me at this point, but we have got a link which we will be sending around after this, where you can actually see that live demo and that's been recorded ahead of this. And I'm really comfortable to talk to anyone on this after this call. Let me take you through how it would work in your. But just some of the headlines here from the screen grab. What we've got here is, first of all, we can bespoke the reports so that they are charity relevant. So they talk about the funds, the restricted, unrestricted, and the sorts of funds that are there. It's cloud-based, so actually you can work on this wherever. You're not going to be forced to go into a laptop somewhere. And if you've left your laptop in one place, you can pick up a tablet and work somewhere else. And also because it's cloud-based, we can collaborate. So we can see what you can see. So if you say, I think I've done something wrong, we can actually sit there and help you work out how you might be able to model those different situations. But the graph there, this is a real situation here. And what we did was we had a kind of baseline position. And then what we did was we started to model through what COVID had actually done, so to show the impact. And you can see side by side the impact. You can imagine that informing the conversations that you have at a board level and also justifying and supporting the strategies that you might need. So second thing to say is these, as well as those features, very easy to use. That's the other feature we wanted out of this. So it's easy for you to go in and say, I want to model a 30% reduction for 6 months, or I want to assume that no one can visit the premises for a period of 6 months from now. And you literally, by clicking on a few cells and doing the drop down and putting the change through, it will change the model there and then for you. You can change the payment terms, and you can also have group scenarios as well. So you can put your shop into here as well as having the main charity. So your trading organisation can be modelled separately, and you can bring that all together. So it kind of ticks the boxes of a simple model, easy to use, easy to collaborate, easy to reach out to us for support, or to within your own team. It has added benefits of being able to use historic data to drive insight and basically a forecast at the click of a button using the historic data. It will also CSV upload from any system, and as I said, we can also create those group reports. Now, I've rattled through that really quickly because I'm aware of time, but as I said, it's really important to think about how you are going to bring together the information to support the going concern assumption for the auditors, but also to make sure that you have thought about those different situations and scenarios. And having worked with a number of organisations recently, a lot are sat there with some very superficial, very headline type considerations of what COVID is going to do for them. And I think as you start to explore those impacts, you start to realise the complexity, prolonged change in the way that we might operate, how people might socially interact, concerns and nervousness about returning back, ability to visit people in their own homes, particularly vulnerable people. There are so many complexities in this that unless you are sat there properly thinking through those scenarios and working out your different strategies, there is a real risk here that you're going to come up with the wrong conclusions. We've put this together. It's designed to be simple, easy, and very accessible for you. So do give me a shout after this. We will share that video through. And if anyone wants to talk it through further, how you might be able to use it, then I'm very happy to spend the time helping you. But at this point, I'm going to hand over to you, Fiona. If anyone's got any questions, please fire those in.
Thanks, Mark. Just by way of background, the Financial Reporting Council that Rob's also referred to, just so that you're aware, they are the regulator for auditors and they are the body that are responsible for setting the UK corporate governance and stewardship codes for companies. In the corporate world, investors have highlighted that their key information needs really relate to areas around things like liquidity, viability and solvency of organisations. And whilst boards can't predict the extent and duration of COVID-19 and the pandemic, nor its consequences for the global economy, it is reasonable for investors to expect that businesses will be able to articulate expectations of the possible impacts on their specific businesses in different scenarios. The FRC have also noted that users of financial statements, as Rob's gone into a lot of detail already on, they really want the organisation's resilience at the moment in the face of the current uncertainty, and to understand the key assumptions and judgments that boards are making when they're assessing their resilience in preparing financial statements. So the availability of cash within a group is really important, and the ability to transfer resources around the group to where it's needed often has operational and legal constraints. So it's really important that where access to further funding is needed, that it's very clearly articulated where that will come from. So the FRC produced a really helpful infographic called 5 current questions that investors should be asking. And we sought to put that into a charity dynamic in terms of what trustees and supporters might be asking. So we took the infographic that the FRC put together, and what we sought to do here is to translate that into charitable language in terms of the sorts of things that trustees should be thinking about and how those things might be translated into their accounts. It's very much, to say, picking up some of the things that Rob's already talked about, so I won't dwell on this for too long, but I think it also links very neatly in with the BDO Rethink model around what we could be doing now, what's the sort of short-term objective, and what's the future look like. So the resources section here is very much around what are the immediate actions and steps that you should be taking. And the first question is for you to really think about how much unrestricted cash does the charity have right now. And just a couple of observations, I suppose, just to bring this to life from my perspective and the conversations I've had with clients recently. Might be worth thinking, for example, if you have investment funds, is there actually unrestricted cash sitting with those investment funds? It always surprises me how many times clients perhaps haven't fully understood the mandate that the investment manager operates under, so that when cash is being cycled, the sale and disposal of investments, whether or not the cash that they're holding is actually accessible or not. And so if you're not familiar with how that mandate works, now's a good time to sort of ask whether there is a requirement for the investment manager to hold on to that cash and reinvest it, or whether you could access it. I mentioned overseas subsidiaries in groups. So I know perhaps that's not always the thing that impacts on a lot of UK charities, but there are many that have overseas subsidiaries, and often we find that the reserves and the cash funds are actually locked in those overseas subsidiaries, and at the moment there may be a heightened sense of awareness of how you can repatriate those funds. And so one of the things you might want to talk about in your report, if you're planning to do that, is perhaps the risks around what the exchange controls might be in place, or whether there is an unexpected cost associated with having to repatriate funds. And of course, in many other situations, we would also be thinking about the cyber and fraud risks here of doing unusual transactions to move funds around between global bank accounts, etc. Also, under here we've got designated funds. We know that lots of charities hold designated funds for reasons, for sort of strategic reasons. Often they are kind of rainy day funds. So, a fairly obvious thing to say at the moment is if you're planning on designating any of those funds to apply to the emergency situation at the moment, that would be something that would be useful to explain in your accounts. And similarly with endowment funds, being very clear, obviously, if your endowments are either permanent or expendable, but if they are expendable and you think that you may need to access some of those funds to get you through this period, it might be worth making sure that you're very clear about the steps that you'll take to do that. The second point here under, what cash and liquidity could the charity obtain in the short term? We've got the obvious things there around overdraft, loan, finance leases that you might have access to. I've also had some really interesting conversations with some clients around seeking advance payments from funders. So, for example, where an annual grant might ordinarily be delivered in sort of 4 quarterly payments, many funders are actually have been happy to provide a year's worth of funding upfront to support that short-term cash flow difficulty. But of course, we need to obviously be very careful to ensure that we don't mix up cash and income when it comes to accounting for those amounts if they relate to services that are provided over the future period. Jill's also mentioned emergency appeals. So if you have had an emergency appeal and it's been successful, it's probably something that you would also want to think about referring to in terms of how much cash you've got, but also whether or not that is available for restricted or unrestricted purposes. Under the action section here, we've got those short-term and longer-term actions. So what can you do to manage expenditure in the short term? We know that obviously many organisations are thinking about how they might be able to extend any payment terms, deferrals, or take payment holidays from things like rents or potentially pension contributions or loan repayments. On the topic of pension scheme disclosures, we are commonly seeing at the moment, as part of the post-balance sheet events note, some reflections of the fact that there is some uncertainty around how COVID-19 will impact on not just asset values, but the liabilities. And as part of a triennial review, there may be a conversation with the pension scheme trustees around the levels of contributions that the employer may be requested to pay. You know, for many organisations in a stable environment, that can be one of the more volatile and unexpected areas of cash flow forecasting. So it's good to engage with those organisations now to see if you can get some visibility over the likelihood of any material changes in cash flows arising in that area. I also think under expenditure, it's also worth reflecting on the fact that for some people, it's not just about stopping activities. It can just be a slowdown in activities which can have an impact on expenditure. So I've been talking to a couple of INGOs, for example, where they're able to continue to deliver their programmes of work, but they've significantly slowed down, and that has a direct impact on the overhead cost recovery models. So going back to funders now and talking about how that might affect the overall budget envelope for a particular project could be really important in terms of working out how that expenditure is going to be covered. In terms of other actions that you can take in terms of longer term viability, we've mentioned the concept here of stress testing, which very much comes back again to Rob's point about what we're doing on going concern. If you want more information on that, I would strongly recommend looking at the ICAEW website, because they produced a really helpful paper on what a stress test is and the steps you might go through to go through that approach. Intergroup considerations are also really, really important in the context of going concern, and looking at whether it's, again, continues to be the right thing for the charity to use its funds to support charity trading subsidiaries if they're no longer able to undertake the activities that they were expecting at the moment. And finally, on the future, again, this sort of wraps up everything that both Rob and Jill have already been talking about. We know that it's clearly very early days for some boards to begin to articulate what that future looks like. But I would say that I have seen some really excellent examples of annual reports for December year ends where there was a reflection of what the strategy was going to be to deliver over the next few years, but they've been able to interweave now that reflection of some of these activities may well change now in light of COVID-19, and perhaps they don't have all the answers, but they clearly know that things are going to have to change. And as a reader of those accounts, I can't stress enough how impactful that is, as opposed to a situation where the annual report is just as it would have been, with just sort of a bolt-on a couple of sentences or paragraphs around COVID-19. So some early thought about how you might translate that into your annual report is really important too. So that's everything from me. I'm going to try and hand back to Jill now to move into the Q&A section.
Thank you, Fiona. So we have got some questions coming through. One around trading companies, and what do we think the Charity Commission and the auditors at trading companies and charities supporting them when they're entering a loss-making position? Something that I know we've been having numerous discussions of internally. I want to pick that one up.
Yeah, I'm happy to kind of talk about the kind of technical point of view of this and also the interaction with regulators, but I realise there'll be some very live, kind of very personal discussions, I suppose, in individual organisations about that, what that looks like. I think you're absolutely right to say, and I alluded to it in my little slot, that we would expect probably in the current situation that subsidiaries that in the past have been very dependent on their parent entity, in most cases the charity, to support them financially, so to top up their budget, to give them money when they need to pay things off and that sort of thing. They might start to be the first thing where costs get cut, where maybe cash doesn't flow to it as readily as it has done in the past. They may be the sorts of organisations which see funding ceased from its parent body. And just a couple of things to say about that. One being, from a going concern point of view, that does give some challenges for the subsidiary itself. If it itself is dependent on support from a third entity, irrespective of whether that's a group entity, it itself has a question to answer about its going concern status. How is it confident? How are the directors or trustees of that entity confident that itself will continue to be able to continue with the support perhaps being kind of shut off more so than it had been in the past? There's also the question about what the charity should do with that subsidiary. Like, we have a number of clients who've suggested maybe we'll just put some money into that sub. Maybe we will provide that sub with a guarantee that we will continue to support it. Some clients have said we actually want that going concern question to go away, so we will loan them some money, or we will give them a much bigger grant so that we know it covers them for the period in question. There's a few problems with that, perhaps regulatorily, if that's even a word, principally because there are normally reasons why you create a subsidiary separate from the core charity structure. There's normally a regulatory, tax, maybe related reasons why you have done that. To offer guarantees and or to provide funding could ask questions about, is that the right thing for the charity to be doing? Should it be putting money into a subsidiary when it's got beneficiaries it should be spending money on? If I am giving a loan to another entity, is that in the best interest of the charity to do that? If I've given a guarantee, does that effectively break that corporate veil between the charity and the sub? But for a charity, there are a few issues with that support and that ability of the charity to do that. So arguably, in some cases, it is actually just more appropriate for the subsidiary to accept that the subsidiary is loss-making. There is a question about going concern, and maybe it's right that we just acknowledge that in our accounts and that the audit report reflects that. If that's a situation that you really don't want to be in, you don't want your subsidiaries having question marks about uncertainty of going concern, then there perhaps is a wider discussion with auditors, with regulators, with trustees about the best way to bridge that gap. It may not be the way that you have achieved it historically, I think is another important point to make. Jill, I don't know if you wanted to pick anything else up on that.
Yeah, I think we've been having lots of conversations actually around this exact point, mainly as we've been going through the December year ends and the subsidiaries linked to those charities. I think there's a couple of points to pick up. One, there's a tax point around are you actually able to make your qualifying charitable donation from the trading subsidiary up to the charity, and if not, there are tax implications for that. So I think if you are in that position, then definitely consult. And the other point for me, which we've been discussing with boards of directors, is just making sure from a governance point of view, you're not blurring the lines with potential conflicts of interest. So you will often have in these trading subsidiaries either a management from the charity as a director, or potentially trustees in common as well. And it's just really making sure that you are thinking as a director of that trading company, because it really needs to kind of stand alone rather than being part of the wider group. Now, I'm conscious that, the vast majority of our trading companies are purely there because of the tax issue, but that we do have some where charities have created them to manage and mitigate risks. And often in those cases, they are delivering part of a charitable purpose and delivering primary purpose. So I think it does need to be looked at on a case-by-case basis, but it's worth having those conversations early. A couple of other questions that we have. We have one around how many charities have accessed the CBILS loans, how have they accounted for this, and some concern that as the loan is spent, they might end up having a negative impact on reserves, including, to the extreme extent, negative reserves. If I start with that, then if anyone else wants to come in, very happy to. I've had a couple of charities in the portfolio who have applied successfully for CBILS, which is great because it has alleviated some cash flow issues. They haven't accounted for that yet because it's been a post-year end thing. They're both March year ends that I'm thinking of. So we are having the conversation with them at the moment around how do they account for that. What we are recommending is that as you're disclosing the ramifications on COVID-19 on not just your reserves policy, but going forward on your financial liability, then that needs to come into consideration. You need significant disclosures in that financial review section where the CBILS loan is one of the key factors for your going concern basis of preparation. So hopefully that makes sense. We will be issuing, because we're getting a number of queries on CBILS, so we will be coming back to you at a later date with some more detailed accounting.
The only thing I'd add is we've had this question a few times looking at CBILS and CCFS as well is another one we're commonly getting questions on. These things are trickier than they might seem at first glance in terms of the accounting implications, primarily because we know that in application there are actually like in the tens of numbers of schemes that are possible from which these things might derive. So there are subtle differences in some of those terms and conditions and different things that might be attached to them. Some of these funding assistance actually look more like grants. Some of them look a bit more like loans. Loans obviously would have the implications that were suggested that you will have an impact on reserves, because the minute you draw that down, you then have a liability to recognise, and it doesn't really matter over what period. The minute you've drawn that down, that then does hit your net assets position, and that will then have its own consequences about when it's called upon, can you repay it and all that sort of thing. But some of them also are starting to seem to have some features of grant arrangements where you may not have to pay back until you decide you're ready to pay it back, and therefore is that not more like income until you get to the point of kind of acknowledging that it's a liability you need to return. So there are quite a few accounting nuances. I think it's important, as Jill has already mentioned, that we consider those on a case-by-case basis, and the technicalities of each one may vary from arrangement to arrangement as well, which is really not helpful, we expect, but that's why we'll put some more guidance out on it.
Yeah, just very quickly to pick up, I've just asked the British Business Bank, and they've said that the numbers haven't been released for the total number of not-for-profit organisations that is due to be released by Treasury in the near. The thing I would add to that is I've dealt with quite a few CBIL applications for organisations, and there is a little bit of a frenzy on this one in terms of the applications going in. Banks themselves are struggling with it. But the other thing is, just because you can borrow doesn't mean you should borrow. And I just want to make sure that's front of mind for people, because the nervousness is as it is made easier for organisations to borrow through the guarantees from the government and the pressure on the banks. Unfortunately, people need to just make sure they can repay that debt, because there's no get out on that one. So only borrow where you actually believe that COVID is a temporary impact, that actually this is going to see your way through it. We wouldn't want organisations to borrow just because they could.
Mark, I think that's a really valid point, and I think my conversations with clients has indicated that trustees are generally quite nervous about this sort of thing, because debt and borrowing isn't perhaps the most common area that they get involved in, and particularly where those loans might be used to sort of invest in new activities where there might not be that certainty over how those income flows will be coming back to the charity, both to fund activities but also repay the loan. Doing some modelling of that and some forecasting around what the different assumptions might be, clearly comes back to, your area of specialism there. That's really important to work out how you model that through. I think linked to the furlough scheme, the questions that's been asked is around treating the grant as restricted if if all the employees are actually that relates to are involved in restricted activities. I think our general approach to this one is that those furlough grants are always unrestricted, so hopefully that's helpful in terms of not having to sort of do quite complex allocations across different types of activities. But again, if you're applying for a furlough loan specifically for to cover an area of your activity, then do get in touch with us and we can talk that one through with you.
Yeah, I think to add on the furlough point, we've had a few questions, not specifically on this webinar, but about accounting for furlough. And the simple answer really with furlough grant is you account for them gross. Ultimately, they are financial assistance, so you have income coming from that, and then you will have the total cost incurred for paying the staff. So your kind of staff costs don't really change unless you're not topping up, if you are limiting it only to the 80% as you're allowed to do. But it needs to be on a gross basis and not a net. You can't pretend that someone else almost has assumed that cost. It remains yours. It is just being covered by some income. I think that's a point to note in terms of the accounting. We have another question about working remotely, which I think is a really good one and one worth bringing out. With more of us working remotely, it is inevitable that some controls may have been modified. If it's reasonable, are we likely to see audit thresholds significantly affected, materiality and clearly trivial items? To be honest, that's a massive question, to be honest, and it's one internally at BDO we've been probably wrestling with ever since the 23rd of March, to be honest. What does this all look like if we are now working under different conditions? I think it's absolutely right to say that controls may have been modified. From an audit perspective, that means we effectively have two periods that we need to look at. It will be the period before the control changed and the period afterwards up to the year end. So there may be a bit more audit work looking at there. If we have a controls-based approach to audit, we may be looking at two different types of testing, to be honest, in terms of how we get comfortable with the control. There was a control, even if they were different controls, that operated effectively throughout the period. But other things control-related might be in relation to just simple things like remote working arrangements. Normally, you'd put a squiggle on a bit of paper to prove that you'd authorised it. What if that's now forming part of an email? And what does that look like for auditors as well? Can we now sign off electronically and all that sort of thing? I think the answer is probably that it depends. It depends on what you're looking at controlling, how effective that system looks to be, whether there's kind of a clear kind of audit trail and paper trail to kind of follow. And I suppose the one thing I would exercise there is a bit of caution that a lot of these technological things that are trying to be frantically implemented since COVID-19 in terms of virtual stuff, virtual evidence, virtual counting, virtual looking at things through a camera and all of that sort of thing, the accounting standards and the auditing standards are not really well geared up to deal with them. So there's a lot of policy and methodology discussions going along amongst a lot of the audit firms to work out where the thresholds actually are. But more generally, you could expect to see, particularly if you're an organisation which has suffered as a consequence of having to move to a remote working arrangement, you can see and expect a lot more attention on susceptibility to fraud from your auditor, for sure, maybe even from regulators, not just auditors. And in terms of materiality thresholds on the accounts, one of the tools that we have as an auditor in our armoury to deal with additional risk is lower materiality levels. So where we think that risk exists, you may well find that materiality changes as a consequence. We're not, though, I suppose, just to stress, we're not doing that as a blanket thing. We're not changing things just for the sake of changing them. We will look at each client and each audit and each set of accounts and think about what the right answer should be.
It's really important those controls, the world has shifted again. So therefore, irrespective of the testing of controls from an audit point of view, organisations should have and should be doing the exercise of redesigning controls to allow for the fact that we now have distributed workforces operating through new systems and new risks that have presented themselves. So again, it's an exercise that needs to take place. And if I was out there as an auditor, I'd be asking what they've actually done to revise controls to reflect the new risks that are presenting themselves.
Thanks, Mark. Yeah, no, that's brilliant. I'm just conscious of time, so I'm going to take one more question, and then the other questions we haven't had time to answer, we will come back to those that have answered the question and try and do those offline. So an interesting one, well, I think it's quite interesting. I think I might change my year end to defer going concern considerations. Is this a good idea? And I've had a similar question from one of my clients. Wasn't quite as leading as that. My client was thinking about changing year ends anyway, and is concerned that it may appear that they are trying to defer their going concern considerations and assumptions. So I think no, it's not a good idea to do that. Would be my my stock answer. But however, if you are thinking about changing year end for a really valid reason, so my client is an education linked charity with a March year end and is looking to align its year end to its customers, its universities that it deals with, and I think that's a really valid reason. So I think if you do have a reason, it's worth thinking through the Q&A that you may get as you publish your accounts for that year. And I would just really think about the timing of that. Is now the right year to do it if you are thinking maybe it's one to defer to next year when things calm down a little bit?
To echo that, we've seen in the public market a couple of entities did change their year end, and for whatever reason they changed it, there was a clear signal that gave. People perceive that to be dodging a going concern question, whether that was right or not. So I just really to echo what you said, we're seeing that elsewhere.
Yeah, lovely. Thanks, Rob. The next slide, which is kind of our penultimate slide, just really highlights a few of the publications that we have been issuing to help and support you. And like we say, we'll send around some links to these. We do have our Covid-19 hub on the BDO website, which is the top right graphic there, and it's really helpful. It's got a lot of information that one we've referred to throughout the webinar, but two, loads more further information on there as well. On the left-hand side, some of you will have already been familiar with that we're trying to update every 2 weeks because things are moving quite quickly. So really just to conclude to say thank you for joining us. We will send the recording and the slides around to you and answer those questions we didn't get to. We'll also be sending around further details of future webinars as well. If you do have any ideas on what you would like us to cover, then suggestions of topics are always welcome. Thank you to our presenters today, and a huge thanks as well to Hannah, who is working behind the scenes to try and keep everything on track for us. Sorry, we've had a couple of issues with the sound there. We will try and sort that out for next time. But yeah, thank you so much, and wishing you a safe and pleasant rest of the day. Thank you so much. Bye-bye.